Hi, everyone. Welcome to Deloitte Financial Reporting Updates, our webcast series for issues and developments related to the various accounting frameworks. Today we present Bringing Clarity to an IFRS World, IFRS 15, Revenue from Contracts with Customers. I'm Jon Kligman, your host for today's webcast, and I'm joined by Maryse Vendette, Cindy Veinot, and Joyce Lam. I'll tell you more about our speakers a little later on. Before we get to our agenda, a few housekeeping items. In the lower right-hand corner of your screen, you'll see the webcast links, including a link to download and print today's slides, and links for webcast assistance and Deloitte updates, upcoming sessions, and archive sessions. If you have a pop-up blocker, you'll need to disengage it in order to download the slides and participate in our polling questions. If you know of colleagues who couldn't attend today's live event, they can simply register at any time the same way you did, and they'll be able to view the archived webcast within 48 hours. So invite your colleagues to take advantage of this feature. Although you're on listen-only mode, you can ask our presenters content-related questions at any time by entering your question in the box at the bottom of your screen and clicking on Submit. We'll do our best to respond to your questions and comments during the presentation. We also have interactive polling questions that will appear on your screen throughout the webcast. We invite your participation by simply answering these questions. A summary of the results will be provided on screen shortly afterwards. Okay, let's get to our agenda. First, you'll hear from Maryse Vendette, who will provide us with an introduction to the new standard and to speak to its scope. As well, Maryse will begin walking us through the steps of the new revenue model. After Maryse, Joyce Lam will continue to walk us through the remaining steps of the new revenue model. We'll then be joined by Cindy Veinot, who will provide us with some guidance on some of the other matters related to the standard and to speak to some of the expected impacts, challenges, and issues. We'll conclude by highlighting some resources for future reference and with a brief question and answer session. You can read the bios of our presenters and access the agenda and technical support in the navigation area of your screen. We have a lot of material for a 90-minute webcast, so we'll need to keep the discussion at a fairly high level. I'd like to remind our viewers that our comments on this webcast represent our own personal views and don't constitute official interpretive accounting guidance from Deloitte. Before taking any action on any of these issues, it's always a good idea to check with our qualified advisor. Okay, to kick things off, let's start with our first polling question. We're going to ask everyone online to participate in this webcast by answering the polling question. And can we have the question, please? There we go. Okay, so the question is, have you started assessing the impact of IFRS 15 revenue from contracts with customers? And the answers are, project plan is in place, aware of the new standard, and will start assessment in the near term, no plan to commence work at this time or not applicable. After you select your answer, which is the best in your circumstances, please remember to hit Submit Answer to register your response. While we're waiting for the responses, I'd like to remind you that today's webcast may be counted towards your continuing professional education. If you stay with us for the whole webcast, you can credit yourself with 1.5 hours towards your yearly total. This applies to those in public practice and those working in industry. We don't issue certificates for the webcast, but your email registration confirmation can form part of your documentation in support of your attendance. Okay, let's see if we have the responses, please. There we go. Okay, so almost 45% are going to start their assessment in the near term, and 11.7% have a project plan in place. So that's a very healthy percentage of the folks online who are either already started or near starting. As you'll hear on this webcast, the new standard can have significant impact on both the accounting and on the information requirements. Okay, I'd now like to welcome our first two speakers, Maryse Vendette and Joyce Lam. Maryse Vendette is a partner with our national office and is a co-deputy leader of the Canadian IFRS Centre of Excellence. She's the national subject matter authority in the field of revenue recognition, as well as a member of Deloitte's Global Expert Advisory Panel on Revenue. Joyce Lam is a senior manager in the Advisory Services Group of Deloitte and specializes in providing accounting advisory services to clients in all industries. Joyce has extensive experience in assisting clients on accounting matters in the areas of revenue recognition, business combinations, and share-based payments under IFRS and U.S. GAAP. Over to you, Maryse.
Thanks, John. Good afternoon, I guess good morning for some of you across the country. Let's start with some background information on IFRS 15. So we received what I would refer to as exciting news in the accounting world on May 28th when IFRS 15 was finally issued. It was issued concurrently with Accounting Standards Update ASU 21409, its U.S. GAAP equivalent. The issuance of IFRS 15 completes a long-standing project that began back in 2002 between the IASB and the FASB to develop a high-quality global accounting standard. For all intents and purposes, IFRS 15 and U.S. GAAP are converged. There are minor differences between the two standards, and those have been identified in an appendix to the standard in the basis for conclusions. This standard addresses how to account for all contracts with customers using one model of accounting that will apply to all types of transactions in all industries and capital markets. So currently, we have diverse pieces of guidance under IFRS, over some 200 pieces of literature dealing with specific transactions or industries under U.S. GAAP. This new standard will replace all or most of that by one model. We'll have to wait and see how it's interpreted and implemented, but the objective is that the new standard will increase comparability, reduce diversity in accounting for similar transactions across industries. We wanted to highlight that the IASB and FASB have created a joint transition resource group. So the members of the resource group have been announced, and they include financial statement preparers, auditors, users, obviously the boards, and members of the regulator community, people in various industries and geographic locations. The purpose of the transition resource group is not to issue guidance, but it's really to solicit, analyze, and discuss issues arising from implementation, inform the boards about the issues that are being dealt with so that the boards can take decisions about actions that need to be taken, provide a forum for stakeholders to learn about the new standard. So the boards expect that the transition resource group will meet twice in 2014 and 4 times in 2015, and the first meeting is scheduled July 18th. All the meetings will be public, and anybody can submit a potential implementation issue for discussion at the Transition Resource Group meetings. The boards will evaluate those submissions and prioritize the issues for discussion. Here, and I realize the text may be a bit small on the slide, but what we have here is to the left of the screen, the requirements currently found in IFRS on revenue in the main standards as well as in the interpretations. And this contrasts with the new requirements to the right of the screen. A couple of points to bring to your attention here. The first one is, as you'll see, IFRS 15 has a broad scope. It has guidance on a number of aspects that are now included in various pieces of literature under IFRS. So IFRS currently has guidance on construction contracts in IAS 11, sales of goods, sales of services under IAS 18, construction of real estate under IFRS 15, and IFRS 15 will replace all of that. And IFRS 15 will not distinguish explicitly, or does not distinguish explicitly, between sales of goods or services, but rather it provides guidance on whether revenue should be recognized over time, similar to a service or a long-term construction contract, or revenue should be recognized at a particular point in time, similar to a sale of good. And we'll discuss that in more detail later on. IFRIC 13 is superseded and replaced by broader guidance on options granted to customers to acquire additional goods or services for free or at a discount, and it provides broad guidance on breakage, customer unexercised rights. IFRIC 18 and SIC 31, dealing with transfers of assets from customers and advertising barter transactions, are superseded, and IFRS 15 includes guidance on how to deal with non-cash consideration and non-monetary exchanges generally. And finally, whereas previously IAS 18 contained specific guidance on accounting for interest and dividends, these are now scoped out of IFRS 15 and dealt with by IAS 39 and IFRS 9. So consequential amendments were made to those two standards to incorporate guidance that was previously included in IAS 18 and its appendices. Moving on to effective date and transition options. So IFRS 15 is effective for annual reporting periods beginning on or after Jan 1, 2017, so including interim periods. So for an entity with a calendar year end, it would apply IFRS 15 in the first interim period ended March 31st, 2017. Early application is permitted under IFRS 15, but it is not permitted under US GAAP. So the boards have provided a bit of relief by way of transition methods. So an entity can choose between two transition options. So it can elect to either apply the standard fully retrospectively, or apply it retrospectively by taking into account three practical expedients to retrospective application, which are identified obviously in the standard. And if any of the practical expedients are used, they have to be applied consistently to all reporting periods. They have to be disclosed, and to the extent that it's possible, an entity would have to include a qualitative assessment of the likely effect of applying the practical expedients. Or an entity can also choose to apply the standard using a modified approach. So that means that it would apply the revenue standard retrospectively, but only to contracts that are not completed as of the date of initial application of the standard. So that's, again, January 1st, 2017. And it would recognize a cumulative catch-up adjustment to retained earnings as of that date without restating comparative figures. So the use of the modified approach may reduce the cost and complexity of adopting the standard because there's no need to make an assessment of contracts completed prior to the year of adoption, but it also has its drawbacks in that some revenue will not be presented in profit and loss, but instead would be included in the beginning retained earnings as a cumulative catch-up adjustment. And obviously, some parallel accounting will be required in 2017 to be able to disclose the information that's required by the standard. So the following slide provides a tabular example that's intended to illustrate visually the two transition methods. So under the full retrospective approach, while it's clear from here that for new contracts and existing contracts, you have to apply IFRS 15 in the current year, but also in the prior year that's presented, and also, to produce your opening balance sheet that would be required under IAS 1 when you apply a new standard. Under the modified approach, the standard would be applied to any new contracts entered into on or after the initial application date of Jan 1, 2017 for a calendar year-end example. An entity would also need to evaluate those contracts that aren't complete at the date of initial application using the new revenue model and determine the cumulative catch-up adjustment to be recorded to beginning retained earnings. And finally, any contracts completed prior to the year of adoption would not need to be reevaluated or accounted for under the modified approach. So that means that revenue from these contracts recognized in prior periods presented would not be restated under this approach. So if an entity decides to employ this modified transition approach, it's required to provide some additional disclosures, of course, to show to users how they transition from the legacy guidance to IFRS 15. So the first of which is to present the financial statement line items and the related amounts that are affected in the current year, in 2017, because of the application of the standard. And second, a description of significant changes between the new standard and the legacy guidance. As mentioned previously, IFRS 15 has a broad and all-encompassing scope. It applies to all contracts with customers, except those that are within the scope of other IFRSs. So it's important to understand how IFRS 15 defines a contract and defines a customer. Under IFRS 15, a contract is defined as an agreement between two or more parties that creates enforceable rights and obligations. And a customer is defined as a party that has contracted with an entity to obtain goods or services that are an output of the entity's ordinary activities in exchange for consideration. IFRS 15 includes in its scope transfers of assets that are not an output of the entity's ordinary activities. So, for instance, transfers of sales of property, plant, and equipment, real estate, or intangible assets would be within the scope of certain aspects of the IFRS 15 model. So specifically, criteria for determining the existence of a contract, measurement, and control principles would apply to these transfers or sales of non-financial assets to determine when and for what amount the asset should be derecognized. With respect to contracts with collaborators or partners, during their redeliberations, the boards acknowledged that parties to collaborative arrangements, which are common in certain industries, such as in the pharmaceutical industry or biotechnology industry, could represent customers, and that therefore certain collaborative arrangements would be within the scope of IFRS 15. So to determine whether a transaction or a collaboration arrangement is in or out of scope of IFRS 15, an entity would consider the structure and purpose of the arrangement to determine whether the transaction is for the sale of goods and services as part of the entity's normal business activities, and whether the counterparty represents a customer. And if that's the case, then the collaborative arrangement would fall within its scope. The revenue model does not apply to contracts within the scope of other IFRSs, so IAS 17 contracts, those within the scope of IFRS 4 for insurance contracts, those within the scope of, financial instruments and other contractual rights or obligations, which would be in the scope of IFRS 9, IFRS 10, IFRS 11, for instance. And finally, non-monetary exchanges between entities in the same line of business whose purpose is to facilitate sales to customers. So on this one, I believe this requirement is a bit different from the scope exception currently found in IAS 18, which would exclude non-monetary exchanges of goods and services that are of a similar nature and value. So there could potentially be differences there in terms of accounting for non-monetary exchanges to watch out for. So, moving on, the core principle of IFRS 15 that you see highlighted here at the top of the screen is to recognize revenue to depict the transfer, so the transfer of control of goods and services in an amount that the entity expects to be entitled to. So the word expects seems to bring in some element of potential variability, and we'll touch upon that a bit later. So there is a 5-step approach to applying this principle, which is not too unfamiliar in terms of an approach. And we name all these steps here, but we'll cover those in turn in more detail. So the first step is to identify the contract. Second step, identify the performance obligations, and that's similar to separating a multiple element arrangement into different units of account. The third step is to determine the transaction price. So that would be the amount the entity expects to be entitled to under the contract. The fourth step is to allocate the transaction price amongst the performance obligations identified. And finally, the fifth step is to recognize revenue when or as performance obligations are satisfied. So that's when control of the goods and services is transferred to the customer. Note that this is not exactly how the standard itself is laid out. It's not necessarily laid out sequentially in terms of the steps. It deals with recognition first, so steps 1, 2, and 5, and then measurement pieces, that's step 3 and 4, and then presentation, disclosure, and effective date. And we've highlighted that for you on the slide. It's also important to point out that this revenue recognition model is based on a control approach, and that differs from the risks and rewards approach that we're used to applying under current IFRS. So the board has decided that an entity should assess a transfer of a good or service by considering when a customer obtains control of that good or service, as opposed to when the supplier gives up control or when the risks and rewards have been transferred. Okay, so now that we've gone through scope, transition, effective date, and the overall model, let's get started with the first step in applying the model, which is to identify the contract with the customer. This is basically identifying the unit of account to which the IFRS 15 analysis will apply. So we mentioned previously that a contract creates a legally enforceable rights and obligations. So a legally enforceable contract would only be deemed to exist if the criteria on the slide here are all met. So first, the parties to the contract have approved the contract. That can be in writing, orally, or in accordance with customary business practices, and the parties are committed to perform under the contract. The entity can identify the payment terms for the goods and services. The entity can identify each party's rights. The contract has commercial substance in the sense that future cash flows are expected to change because of the contract. And finally, it's probable, which means more likely than not under IFRS, that the entity will collect the consideration to which it's entitled in exchange for the goods and services. So this collectibility threshold is assessing the customer's credit risk. And you may recall that in the exposure draft, there was no collectibility threshold. So in this final standard, they've reintroduced a collectibility threshold of probable. It's also important to note that there's a difference between consideration from a customer not being collectible and the entity offering a concession to a customer, and the standard goes into some discussion about that, and we'll provide an example of that later. If the arrangement fails to meet these criteria that we've just gone through for identifying a contract, the entity will have to reassess every reporting period whether it subsequently meets these criteria. However, an entity would not be able to recognize revenue from a contract that fails this step until either it reassesses collectibility and concludes it becomes probable, and or the amounts received are non-refundable, and either the entity has satisfied all its performance obligations and all the consideration has been received and it's not refundable, and the contract has been terminated or canceled, and whatever consideration has been received is non-refundable. So as well as a final point on this step, IFRS 15 also includes guidance under Step 1 on how to determine whether contracts need to be combined when they are entered into at or near the same time with the same customer, and also deals with some questions about contract modifications, and we'll discuss that a bit later as well. Step 2, identifying the performance obligation. So this is basically identifying the deliverables or identifying the elements of the arrangement that may be terms that you're more used to. So what is a performance obligation under IFRS 15? Well, it's a promise to transfer to the customer a good or service or a bundle of goods and services that is distinct. So the first thing to do is to identify all the promised goods and services in the contract. IFRS 15 provides a list of typical promises you may find in a contract, but this list is not all-inclusive. These promises in a contract can be explicit or they can be implicit, meaning that they're implied by customary business practices, published policies, or specific statements that create valid expectations on the part of the customer that they will receive those goods and services. An example of that may be a practice of offering a free one-year maintenance with the sale of a product. The second thing you need to do is to determine whether the promised goods and services that you've identified are distinct from other goods and services in the contract. And there's two criteria that have to be met to conclude that they are distinct. The first one, to the left of the screen there in the light blue box, is the good or service capable of being distinct? So basically, the question is, can the customer benefit from the good or service on its own or together with other readily available resources? So that's similar to the standalone value test that we may be familiar with. And we don't necessarily expect a change in practice in this regard. The second criteria is the good or service distinct in the context of the contract? So is the good or service separately identifiable from the other promised goods and services in the contract? And that is a new requirement that goes over and above the standalone value test. IFRS 15 sets out a number of factors to consider in making that determination. And we expect a lot of discussion around this application of the second criteria, which could lead to more combining of promises than is currently the case. So if the good and service is deemed to be distinct, then you would account for it as a performance obligation. If not, then you would have to combine two or more promised goods and services and reevaluate what's the lower level that you can find that is distinct within the arrangement. And a final point on this one that I'd like to make here is IFRS 15 also identifies that it's possible that you have a promise to transfer to a customer a series of distinct goods or services that are substantially the same and have the same pattern of transfer to the customer. And the guidance explains what is meant by that exactly. And they say that in that case, if you meet these criteria, then you should account for the series of distinct goods and services as a single performance obligation. So an example of that is a contract by a payroll provider to provide weekly payroll services over a 12-month period. So, one might conclude, well, this is really 12 months of different services or 365 days of services. But in this case, IFRS 15 would lead you to the conclusion that it's only one performance obligation. The contract includes one because the entity is providing a series of distinct services that are substantially the same and have the same pattern of transfer throughout the year. So let's now look at an example. Here we have an example of how Step 2 might apply to a specific fact pattern. So the facts we're working with, an entity's manufacturer enters into a contract to sell a customer a printer and an ink cartridge that is shipped 2 weeks later. The printer can't work without the ink cartridge, but both the printer manufacturer and the sellers of generic ink cartridges sell ink cartridges for the printer separately. So the question is, are these performance obligations? So the entity here would identify two promises, the printer and the cartridge, and two performance obligations in this fact pattern. Both the printer and the cartridge represent distinct goods because, first of all, it's clear that the customer can benefit from the good on its own or together with other resources that are readily available to the customer. And secondly, the entity's promise to transfer the good or service to the customer is separately identifiable from other promises in the contract. So the customer does not need to buy the cartridge or the printer from the entity in order to use the other good. There's a point of caution here, though. This conclusion is based on our current understanding of the IASB's intention for interpreting this requirement. However, there is some debate among preparers, users, and auditors as to whether, in this case, the two products are separable in the context of the contract because of the notion of, are the goods and services highly dependent or are they highly interrelated? So we expect further discussion on this issue, and it may actually be an issue that will be raised at an upcoming Transition Resource Group meeting later this year. So that's all from me for Step 2. I think I'll hand it over to Joyce to go through the next steps in the model.
Thanks, Maryse. The third step of the revenue model is to determine the transaction price. Under IFRS 15, transaction price is defined as the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to the customer. In determining the transaction price, companies will need to consider the amount of fixed consideration, variable consideration, as well as any non-cash consideration in the contract. An example of non-cash consideration can be shares of the customer common stock. Under the new standard, we are required to adjust the transaction price to exclude the effect of time value of money if there is a significant financing component embedded in the contract price. Also, the transaction price should be adjusted for any consideration payable to the vendor to the customers. This last requirement to adjust the transaction price by consideration payable to the customers is essentially the same as what we're used to under EIC 156 under the old Canadian GAAP. We should also note that in determining the transaction price, we do not adjust for the effect of customer credit risk. As Maryse has mentioned, and also you may recall, back in the 2010 exposure draft, it was proposed that the transaction price be measured based on the amount that the entity expects to receive, which effectively requires the entity to reflect the customer's credit risk in measurement of the transaction price. However, because nearly all respondents expressed concerns about applying that concept, the boards have decided to not adopt that proposal. The boards later came up with another proposal in 2011 by proposing to have the effect of the credit risk presented as an adjacent item to the revenue line in the statement of earnings, which they have also later abandoned that proposal. One of the main concerns is that they were concerned company may be grossing up their revenue balance with an offsetting impairment loss. So in the new standard, the boards ultimately decided that they would include the consideration of collectibility in step 1 of the revenue model. And the reason for including that in step 1, essentially that provides a critical consideration point in determining whether or not the contract is valid. So what constitutes variable consideration? Variable consideration is any consideration that is subject to uncertainty other than collectibility. For example, discounts, rebates, sales credits, sales incentives, performance bonuses, or price concessions. When the transaction price is variable, the standard requires the entity to estimate the variable consideration using one of two methods: the expected value method or the most likely amount method. The expected value method is calculated using the probability weighted method, which is appropriate when the entity has a large number of contracts with similar characteristics. The most likely amount method is appropriate when the contract only has two possible outcomes. For example, the entity is entitled to a performance bonus only if it achieves a specified outcome. However, if there is a high probability that a subsequent change in the variable consideration estimate will lead to a significant revenue reversal, the variable consideration should be excluded from the determination of transaction price. In assessing the likelihood and the magnitude of a potential revenue reversal, companies should consider the following factors: whether the consideration is highly susceptible to factors outside the company's control or influence. For example, for an asset management company, is usually they will have a portion of their fee earned on the investment portfolio based on the performance at a certain point in time, which in their case, there might be a lot of factors affecting the value or the performance of the investment portfolio, and those factors are typically outside of the control of the asset management company. We also need to look at whether or not there's any uncertainty relating to the amount of consideration that is, and whether or not that uncertainty will take a long time to resolve. As you may expect, the longer the time it takes to resolve the uncertainties around the variable consideration, the higher the likelihood that those estimates are going to change. Also, we should consider whether or not the entity has limited experience with similar contracts and therefore limiting their ability to estimate variable consideration. Also, if the entity has significant historical experience in offering a broad range of price concessions or made significant changes to the payment terms of the contracts, as well as any relevant provisions, it will also increase the likelihood of changes in the future. The last indicator is whether or not the contract itself contains a large number and a wide range of possible consideration amounts. If any of these factors exist, it is an indicator that there is a high probability that a significant revenue reversal will occur and that the entity should not include the variable consideration in the determination of transaction price. Now, let's go through an example to illustrate the point. In this example, the entity sells a prescription drug for $1 million, payable in 90 days, to a customer located in a country that is experiencing economic difficulty. At the time when the contract was entered into, the entity determines that there is a significant risk that the customer will accept the product, and also there is a high probability that the customer will ask for a price reduction, which is a customary business practice in that country. The entity estimates that the parties will ultimately settle on a price of $400,000, which the entity is willing to accept as it will still make a profit at that price. The entity also assesses that it is probable that it can collect the $400,000. So in this example, is the transaction price variable? Does this contract meet the criteria laid out in step 1 of the revenue model? With respect to the first question, the transaction price contains a variable consideration component because both the customer and the entity expect to ultimately settle at $400,000, which in effect means the entity expects to offer a price concession of $600,000. The transaction price is variable. In terms of whether the criteria in this step 1 are met, you can see on this slide that we have concluded all criteria are met. Based on the case facts, both parties have approved the contract and are committed to perform under the contract. The entity has transferred the drug and expects the customer to pay a portion of the contract price. The entity believes that it is probable that it will collect, however, expects to offer a price concession based on the expected amount to collect. The contract has commercial substance, and the entity has identified each party's rights regarding the prescription drug, and the payment is also identified in the payment terms is also identified in the contract. The important point that we want to highlight in here is that the entity has adjusted the transaction price for the estimated price concession and not for the customer credit risk. Also, the criterion relating to collectibility is assessed based on the amount that the entity expected to be entitled to, which in this case is the amount after the adjustment for the price concession. And because it is probable that the entity will collect the $400,000 transaction price, therefore collectibility criterion along with the other criteria in the step 1 are met. The reason that we address the criteria under step 1 in this example is to reiterate that the consideration of collectibility should be based on the entity's transaction price after adjusting for any variable consideration and not necessarily based on the contractual price. If the assessment is based on collectibility of the contractual price, the entity would not meet the collectibility criteria in step 1 under the revenue model. Now, let's move on to step 4 of the revenue model, allocating transaction price. Under the IFRS 15, transaction price will be allocated to the different performance obligations identified in step 2 based on their relative standalone selling prices. If the standalone selling price are not observable, either because this is a new product or a new service, or the entity has never sold those products or services on a standalone basis, the entity is required to estimate the standalone selling price. To estimate standalone selling price, there are a few acceptable methods under the standard. The expected cost plus margin method, which we're all familiar with. The adjusted market assessment method, which is estimated by reference to prices of similar goods or services in the market and adjusted for the entity's specific costs and margins. Or the residual method. Note that the residual method is expected to be used if the price is highly variable or uncertain. In situations where the transaction price changes from the initial allocation, for example, due to change in estimate of variable consideration, the changes should be allocated to the performance obligations based on their relative selling prices, unless the change in the transaction price relates entirely to one or more, but not all of the performance obligations. Also, the initial allocation of transaction price does not need to be adjusted if the standalone selling prices of those performance obligations change in subsequent periods. This concept is the same as the current practice. The standard also provides guidance for situations where it would be appropriate to allocate the discount or any other variable consideration to one or more, but not all of the performance obligations. For example, in the transactions where the entity sells the customer 3 different products, product A, B, and C, for $130. The entity sells each of those products on a standalone basis and has a standalone selling price for each of them at $50 each. So in this transaction, the sum of the standalone prices equals to $150. Comparing to the $130 transaction contract price, there is a discount of $20 in this arrangement. The entity also sells product B and C in a bundle on a standalone basis and also usually price the bundle at $80. So the bundle itself contained a discount of $20. In this case, because the discount that typically offered for the bundle of product B and C is equal to the discount being offered in the current transaction, the entity would, under IFRS 15, allocate the entire $20 discount to product B and C only. Once the transaction price is allocated, the entity will have to determine when to recognize revenue for each performance obligation. Note that there is only one single model for recognizing revenue for goods and services. The new standard does not distinguish recognition of revenue for goods or for services. Under IFRS 15, revenue is recognized when control of the good or service is transferred to the customer. Sounds simple? There are actually many situations where it is not clear as to when control is transferred, particularly when the arrangements involve construction of an asset or rendering of services over a period of time. The standard does provide some indicators to help companies in their determination of whether performance obligation is satisfied over time or at a point in time. It is considered that the entity satisfies a performance obligation over time if one of the following indicators exist. The first indicator is that the customer receives and consumes the benefit as the entity performs. An example of such contract is when an entity provides cleaning service to a customer where the customer is simultaneously receiving and consuming the benefit of the cleaning service as the entity renders the service. The second indicator is that the entity's performance actually creates or enhances an asset that is controlled by the customer. An example is a home addition contract where the entity is contracted by the customer to renovate their customer's house. The last indicator is in the situations where performance by the entity does not create an asset that has alternative use, meaning there is limitation as to the entity's ability to use the asset created for another customer or redirect the asset without having to incur significant cost. and that the entity has an enforceable right to payments for performance completed to date and expect to fulfill the contracts as promised. The amount that the entity is entitled at any point in time during the term of the contract should approximate the selling price for the asset created or partially created. We will illustrate this point in an example in a later slide. When the performance obligation is considered to be satisfied over time, the entity would recognize revenue based on the progress towards completion, which the progress can be measured using either the input or output method. On the other hand, if the performance obligation is not considered to be satisfied over time, revenue should be recognized at a point in time, which is at the time when control of the asset is transferred to the customer. The determination as to when control of the asset has been transferred can be made based on the following indicators. When the entity has a present right to the payment for the asset, when the customer has the legal title to the asset, when the entity has transferred physical possession of the asset, when the customer has significant risks and rewards of ownership of the asset, or when the customer has accepted the asset. To illustrate whether revenue should be recognized at a point in time or over time, let's walk through an example. A manufacturer enters into a contract with a customer to produce 52,000 units of a customized part, which cannot be sold to any customer without substantial rework. The entity expects to produce and ship 1,000 units per week. Under the contract, if the customer cancels the arrangement for reasons other than the entity's failure to perform, the customer is required to pay the entity an amount equal to cost plus a reasonable margin for each unit produced or partially produced but not yet delivered. So, should the entity recognize revenue at a point in time or over time? To help make this assessment, we should ask ourselves two questions. First, does the product have an alternative use? Second, does the entity have an enforceable right to payment? For the first question, because the parts produced are customized and cannot be sold to other customer without substantial rework, these products are deemed to not have alternative use. Regarding the second question, as agreed in the contract, the customer is required to pay the entity an amount equals to cost plus a reasonable margin for each unit produced or partially produced but not yet delivered if the customer cancels the contract. As such, the entity has an enforceable right to be reimbursed for each unit produced or partially produced, even if the product has not been delivered to the entity prior to its cancellation. Therefore, in this example, our conclusion is that the entity will recognize revenue over time on the basis that the asset produced does not have an alternative use and that the entity has an enforceable right to payment that approximates the selling price of the goods produced to date. What if we change the fact of the previous example and stated that the contract terms require the customer to pay the entity an amount equal to just the cost for each product or each unit produced or partially produced? Should the manufacturer recognize revenue over time or at a point in time? With this change, the entity does not have an enforceable right to payment that approximates the selling price of the goods transferred to date. It does not meet the criteria to recognize revenue over time. Therefore, revenue would be recognized at a point in time. The entity would recognize revenue when control of the product is transferred to the customer. To make this assessment, the 5 indicators laid out on the slide should be considered in determining at what point has control been transferred to the customer. Whether or not it would be at the time when the entity has the present right to payment for the asset, or when the customer has the legal title to the asset, when the entity transferred the physical possession of the asset, when the customer has the significant risks and rewards of ownership of the asset, or when the customer has accepted the asset. And now I'm going to turn it back to Jon for a second polling question.
Thank you very much, Joyce, and thank you, Maryse. And let's move on to our second polling question. What step of the revenue model do you think will have the most significant impact on your organization? Identifying the performance obligations, determining the transaction price, allocating the transaction price to the performance obligations in the contract, or determining when to recognize revenue. Remember, once you select your answer, remember to click on Submit Answer to register it. While we're waiting for the votes to come in, I have a question here for Maryse, and it deals with the scope of IFRS 15. The question is, how about those contracts that are only partly in scope? For example, leases and financial instruments and similar kind of subject areas. How will this fit under IFRS 15?
Sure, Jon, that's a good question. So, yeah, as you mentioned, a contract with the customer may be partly within the scope of IFRS 15 and partly within the scope of another standard. And the examples you gave are good examples. So leases could be one of them. So you could have a lease with a service element, or you could have even maybe an investment banking situation where you have an M&A deal. You could have an investment banker that enters into some type of financing arrangement, but also has other services like M&A services. So the idea is that if the other standard that applies specifies how to separate or initially measure any parts of the contract, well, the entity first applies those separation and or measurement requirements, so that other standard takes precedence over IFRS 15. If the other standard is quiet on that topic, so it doesn't specify how to separate or initially measure any parts of the contract, then the entity would apply the requirements of IFRS 15 to separate and initially measure those parts and, allocate consideration based on a relative standalone selling price method. So I hope that answers the question, Jon.
Certainly does. Thank you very much. Okay, let's see if we can get our results of polling question number 2 up there. This one, I was trying to guess which would be the most popular one, but it's 41% is determining when to recognize revenues. People view as the most challenging, with a third saying allocating the transaction price to the performance obligations in the contract. I think this is going to depend very much on the nature and complexity of a particular business, because I think it might actually vary. Okay, I'll now welcome our next speaker, Cindy Veinot. Cindy Veinot is a partner in Toronto and has over 20 years of public accounting experience with Deloitte in both Toronto and the United States. She has worked with clients on revenue recognition issues under multiple different accounting frameworks over the last 15 years and is currently focused on working with clients in assessing the impact of the new revenue recognition standard. Over to you, Cindy.
Thanks, Jon. Okay, well, now that we've walked through the model, let's talk about other aspects of the standard that provide new or more specific guidance in a number of areas. And the first area that we've selected to focus on is contract modifications. Modifications to contracts happen rarely in some industries, but actually happen quite regularly in others. So think about your own cell phone contract. Maybe you've added features to it, you're now data sharing with someone, you've added some additional bells and whistles. There's modifications there, or you can think about a home renovation or a major construction contract for a highway or a new manufacturing plant where there can be numerous change orders. And the standard has specific guidance to deal with the accounting for modifications. And depending on the nature of the modification, the impact can be to treat the modification prospectively or to record a cumulative catch-up in revenue. So let's start at the top of this slide. When you have a modification, you need to determine whether the additional goods or services are distinct. So that's what Maryse talked about in step 2. And whether they have been priced at their standalone selling price. So Joyce touched on that a little bit in terms of allocating the transaction price. If both of these conditions are met, then the new performance obligations and the transaction price associated with them are accounted for as a separate contract. But if that's not the case, then the contract modification is accounted for on a combined basis with the original contract, But the impact on that accounting still depends on whether the goods and services in the modification are distinct. If they are, we're on the far left at the bottom of the slide. There's no impact on revenue already recognized, but the remaining performance obligations are allocated revenue based on the remaining revenue not yet recognized under the original contract and the revenue from the modification. And we'll go through an example of this. If the goods and services are not distinct, which may be the scenario in the case of a change order for a construction project, where there may just be a single performance obligation, then you have to look at the modified contract in its entirety and determine if there is a cumulative catch-up at the date of modification regarding the amount of revenue already recognized, based on applying either an input method or an output method or whatever the appropriate model is, as Joyce touched on. And finally, down there on the right-hand bottom side, you could have a combination of these two types of modifications, and you'd have to apply judgment to account for the modification in a way that is consistent with the principles that we just discussed. So let's walk through an example. So in this case, we have an entity that enters into a 3-year contract to provide daily cleaning services. The customer pays a standalone selling price of $100,000 at the beginning of each year, so a $300,000 contract in total. At the end of the second year, the contract is modified, and the fee for the third year of services is reduced to $80,000, plus an additional $200,000 to extend the contract for 3 additional years. The standalone selling price of the services at the beginning of the third year is $80,000 per year. And the entity's standalone selling price multiplied by the number of years is deemed to be an appropriate estimate of the standalone selling price of the multi-year contract. So in other words, if you take the standalone selling price for 4 years, which is 4 times $80,000, that standalone selling price would be $320,000. So in terms of determining how to account for this modification, there are 2 steps. So first, are the services in the modification distinct? And second, is the additional consideration reflective of the standalone selling price of the services? So we're going to start looking at the chart on the top right corner of this slide. And so in the first column of that chart, we've got all the years. So now it's a 6-year contract after the modification. It was 3 years to begin with, and an additional 3 years were added. In the middle column, we've got the initial amount of revenue that was agreed to by the parties, which was $100,000 in each year of the first 3 years. And then in the last column, we've got the modified amount. So as we noted on the previous slide, at the end of year 2, the price for year 3 was reduced to $80,000, and there was an extension to the contract for 3 additional years at $200,000 in total. So let's go back to the questions now. So first, are the services distinct? We would say yes. The daily cleaning services are something the customer can benefit on its own, and it would be separately identifiable in the contract. The second question is the additional consideration reflective of the standalone selling price of the services? And in this case, we would say no, because the amount of the additional consideration or the remaining consideration to be paid is $280,000, $80,000 for the third year and the $200,000 extension. And this does not reflect the standalone selling price of the services to be provided. So in this case, it doesn't meet the requirement to account for it as a separate contract, and you would have to account for this as a termination of the original contract and the creation of a new contract with the consideration of $280,000, which is $80,000 left from the third year and $200,000 for the new 3 years, to be recognized over the 4 remaining years of cleaning services, or $70,000 per year. The closing thought on modifications is there is now a lot of detailed guidance, so it's going to take some work to ensure that the right processes and controls are in place to monitor them and then determine what the appropriate accounting should be. Next, we're going to talk about licenses. And the main point here is that a license, depending on its attributes, can be accounted for in one of 2 ways. It can be accounted for as a performance obligation that the entity satisfies at a point in time, or it can be an obligation that the entity satisfies over time. So Joyce touched on those 2 different models of recognizing revenue, and depending on the circumstances, both can apply when you're talking about licenses. The first step is to consider whether the license is distinct or included in a bundle of goods, so back to step 2. So an example that you might think about as I walk through the rest of this slide is a software license. And in the software industry, often an entity also sells a maintenance contract which provides the customer with when and if available upgrades. So if the license is evaluated as distinct from the maintenance contract, then it's only the initial license that we're talking about in terms of making this next assessment. And the key question is, what is the nature of the entity's promise? So they have a right to access the intellectual property of the company throughout the license term, or just to use the intellectual property as it exists when the license is granted. And a few consideration points that are noted there on the right-hand side of the slide. Is there an explicit or implicit understanding that the entity will undertake activities that significantly affect the intellectual property? Do the rights granted by the license expose the customer to any positive or negative effects? Do the activities result in a transfer of a good or service to the customer as those activities occur? I would say there's some very interesting examples in the standard that cover the licensing of intellectual properties in various forms. So I touched on software, which, if you just thought about the software license, you might come to the conclusion that it would be satisfied at a point in time when you're only thinking about the license, like a license to use Word or Excel or something like that in this example. But there are also many other examples that cover things like patents for drug compounds, franchise rights, images, music recording, movies, logos. So if you're in the business of licensing intellectual property, I would certainly take a look at those examples, because I think it's going to be a challenging determination in some cases to determine what the appropriate model is. This next area might be a bit of a sleeper, but there actually is guidance in IFRS 15 in terms of how to treat costs, and those include costs to obtain a contract and cost to fulfill a contract. With respect to cost to obtain a contract, these are capitalized if they're incremental and expected to be recovered. So the most frequent example of these types of costs are sales commissions. There is a practical expedient in the standard where if you expect that you would amortize the cost over 1 year or less, you don't have to capitalize it. Then we've got costs that are incurred to fulfill a contract, and these costs are accounted for in accordance with other standards to the extent that they're within the scope of another standard. So inventory or property, plant, and equipment would be accounted for under the respective IFRSs. But if they're not within the scope of another standard, then this guidance applies. And this guidance requires an entity to capitalize the cost to fulfill a contract if they relate directly to a contract or anticipated contract, if they generate or enhance a resource that will be used to satisfy obligations in the future, and if they're expected to be recovered. There are specific exclusions in the standard for types of costs that cannot be capitalized, so things like general and administrative costs, wasted materials. There's a number of things to think about. Like costs to obtain a contract, once capitalized, these costs are amortized on a basis consistent with the transfer of the goods or services. And in addition, the standard does include guidance on assessing these costs for impairment and then potentially reassessing them and potentially reversing the impairment charge if facts and circumstances change. This slide includes a smattering of other matters, so just things we wanted to bring to your attention in terms of guidance being in the standard, and I'm going to talk about them starting at the top left and going clockwise. So product warranties. So there's guidance in the standard on the accounting required for standard assurance warranties. So the type of warranty you would get if you bought a product and it basically has a warranty that says it will perform based on the stated specs for a year, and if it doesn't, you're covered by warranty. Those types of warranties will continue to be accounted for using a cost accrual method. But there are other types of warranties like extended warranties or things that are called warranties, but they're more akin to extended service contracts, and those would have to be accounted for as separate performance obligations. Moving on to the box on the top right, we'll talk about options to acquire goods or services. And this is the guidance in the standard that requires you to assess whether something in the contract provides the customer with the right to acquire future goods or services for free or at a discount. So this is where the guidance from IFRS 13 fits into this new standard regarding loyalty point programs. Now to the bottom right, customers' unexercised rights. This is the concept that we refer to as breakage. So a simple example is If I sell a prepaid phone card and I sell thousands of these cards, and I know from historical experience that customers don't use up all of their minutes, the question is when to recognize revenue for those minutes that will never be used. And you can, the standard basically points you to evaluate the same criteria as Joyce talked about when looking at variable consideration to determine if you can recognize that expected revenue as you deliver service, or whether you have to wait until it's remote that the customer is going to exercise its rights. And then finally, the last box is repurchase agreements. And so here, if an entity has an obligation or a right to repurchase the asset, then generally the customer has not obtained control over the asset. And therefore, you don't have a revenue contract to account for, but you have a lease or a financing arrangement. And a final topic in the other matters section that I want to touch on is disclosures. So suffice it to say the disclosure requirements with respect to revenue recognition have increased significantly. We've bucketed the disclosure requirements into 3 different categories, and the first is at the top is it groups those that relate to disclosures about contracts with customers. So first up, disaggregation of revenue. The standard requires more granular detail about revenue to be disclosed. And to determine how you actually go about that, you need to consider information presented about revenue in other documents, such as investor presentations, and also consider how the chief operating decision maker looks at the information. The disaggregation could be by type of service, by geography, by type of customer, by contract duration. It really depends on how the contracts are impacted by economic factors. With respect to contract balances, there is required disclosure for what's sitting on your balance sheet, so receivables, contract assets, contract liability balances, if they're not already separately presented, as well as what I would refer to as information about transactions that span over multiple periods. So, for example, there's a requirement to disclose revenue recognized in the current period that was included as a contract liability at the beginning of the period. There's also a requirement to disclose revenue recognized in the period from performance obligations that were satisfied in prior periods. So if you think of the variable consideration that Joyce was talking about, you could be constrained in recognizing that until the uncertainties are resolved, but the performance obligation could have been recognized long ago, so the standard is requiring you to provide disclosure with respect to that. There are also several required disclosures about performance obligations, including what remains outstanding at the end of the period and when the entity expects to recognize that revenue, as well as general information about when the entity typically satisfies performance obligations. You know, for example, you might typically satisfy a performance obligation upon shipment of a good or upon delivery. Also information about significant payment terms, as well as other items such as types of warranties. Then looking at the bottom row, there's disclosure required about significant judgments, including those related to timing of recognition of revenue, as well as transaction price and its allocation. And then finally, there's required disclosure about policy decisions. For example, if you're utilizing any of the practical expedients, as an example, the one I touched on in terms of not having to capitalize costs of obtaining a contract if the amortization period would be less than 1 year. You have to disclose information about those. You have to disclose information about the contract costs themselves, whether they be cost to obtain a contract or cost to fulfill a contract, including both closing balance information by category of asset, as well as methods and amounts of amortization. And while that's a number of examples with respect to disclosure, I would just say that there are many, many more. So I think it's an area to start thinking about early. Even if you don't think you're going to have that many impacts from the standard in terms of timing or measurement, I think you will have impacts from disclosure. John, I'll turn it back to you.
Okay, thanks, Cindy. And we'll pause there for another polling question. And the question is, do you believe the new standard will require significant changes to current IT systems and processes? Potential answers are yes, no, not assessed at this time, or not applicable. Remember to click on Submit Answer. While we're waiting for the polling question to accumulate the results, there's a question here for you, Cindy, and it relates to contract costs. And the question is, what if I sell a bundle that includes a loss leader? Do I still capitalize the cost to fulfill related to the loss leader?
Well, I would say that probably the first thing you need to do is go through your allocation process in terms of allocating revenue to your deliverables, because if you have a loss leader, then I guess I would first question in terms of how you're allocating fair value to your transaction. But then there are requirements in the standard to consider impairment analysis for contract costs. So I think that would be the second step of working through that analysis to determine whether you'd have contract costs to capitalize.
Okay, thanks. Okay, let's see if we've got our results for this third polling question. And, well, 44% say that it's not yet assessed, and the other is almost a dead heat, statistically insignificant difference between those who think that it will have an impact on IT systems and processes and those who don't. And on the subject, Cindy is going to now speak about some of the impacts on processes and systems.
Okay, thanks, John. So we've walked through a lot of technical material over the last hour and a bit. So now we're going to spend some time on recapping and thinking about how to begin implementing the impact of this new standard. Certainly, I think, as John mentioned earlier, given the diversity in terms of how organizations generate revenue and how they contract with their customers, the impacts of adopting this new standard will be just as diverse. But on this slide, we've tried to highlight some of the significant impacts from the standard. And I think step one for many organizations will be figuring out at a high level where the hot spots are for your organization. So, for example, do you have contracts with multiple performance obligations? And is the separation guidance in this standard going to change how you currently separate those obligations? Or is it going to change how you allocate consideration to the performance obligations that you've identified? Do you have contracts with variable consideration? And how are you accounting for that variable consideration today? In some cases, depending on the nature of the variable consideration, the standard may require you to come up with an estimate, and Joyce talked about the two methods that exist, either expected value or most likely amount, and actually record that, or once you go through all of those criteria that need to be taken into consideration in terms of assessing whether you might have a significant revenue reversal, you may find that you actually have to delay recognition of variable consideration as compared to what you're doing now. I just touched on contract costs, and you may need to rethink what you're doing there in terms of capitalization. And if you have to capitalize those costs, then you need to think about how you're going to amortize them and whether how you would assess them for impairment. And I think the guidance from my perspective on modifications and licenses is fairly complicated. So if those are areas that impact your business, I would take a good look at those new provisions and the examples. And then finally, as I noted earlier, disclosure is really going to impact every organization that has material transactions within the scope of this standard. And I think for the most part, that's going to be almost every organization. Certainly there will be a few that have all of their contracts with customers or revenue transactions within another standard, but most organizations are going to be hit some way by this new standard. And we often leave sorting out disclosure until after we've figured out the accounting. But because there are so many new disclosure requirements that will drive the need to collect data, it's probably something to make sure you touch on in terms of doing your initial assessment. So there's many ways to approach working through the impact of a new standard like IFRS 15, and these are just some initial thoughts on one approach. So across the top of this slide, we've got three different, I would say, steps. So the assessment phase, a business analysis phase, and an implementation phase. And then just to start down the column on the left-hand side of all the various things that you'd want to be thinking about. So, technical accounting we probably will all have. But I think data and systems definitely could be impacted and will be impacted for many organizations, looking at controls, and then just program management and other things like taxes, communication, training. All of those things need to be put in place. So during the assessment phase, you might start that by first of all, going through a completeness check for scope to ensure you've captured all the revenue that will be subject to the requirements of IFRS 15. And then, maybe taking a sample of contracts or revenue streams and just walking them through the standard to ensure that you've identified all of the areas of potential change. Also, it's a good time to start identifying system impacts. And once you've done that, then I think you'd be in a good position to develop a preliminary project plan, including your communication requirements. In the second stage, I think you'd start to delve deeper and start to develop policies and determine the adoption methods. So Maryse touched on earlier in the presentation about the different alternatives that are available, and you might want to think through what method you want to select, because I think, especially if you're doing full retrospective, you might want to get started earlier rather than later. And then figuring out the system requirements. So, what rules does your system use to recognize revenue now? And if your timing of recognition changes, can your system actually accommodate that? Or what do you need to do in terms of building a bridge or doing something different in terms of ensuring that your system is going to be able to handle these changes? And then thinking about impact on controls. So, again, I'll use modifications as an example. Do you have controls in place to capture modifications and look at the impact of modifications, because the accounting can be different depending on the type of modification? I think this is a good time to also start evaluating training requirements, to update stakeholders, and to consider any tax implications that may result from the standard. And finally, implementation. By this time, you'd be into preparing disclosures, ensuring that your auditor is up to date with all of the decisions you've made to date and concurs with them, certainly well into systems testing, rolling out training, and updating stakeholders. So I think it's quite a process to go through. And of course, beneath each of those steps, there are numerous other steps to consider. And finally, we'll just touch on what we call the broader impacts. So on this slide, we've identified a number of stakeholders down the left-hand side that will be potentially interested in understanding what the impact will be. So we've got lenders, market, investors, employees, the board. And across the top, the different types of impacts that actually could come into play. So things like perception and understanding of analysts and broader market impacts. Certainly the markets will want to know if your revenue recognition model is going to change significantly. Does it impact the availability of profits for distribution? Does it change key performance indicators and other metrics that you might use to manage your business internally? If we could just advance the slide. Are there things like potential non-compliance with loan covenants? So you're going to have new assets and liabilities on your balance sheet. You're going to have potentially different timing in terms of revenue recognition. So how does that impact the covenants that you may have in place? And then finally, last but not least, if you have compensation and bonus plans in place that relate to financial performance, and financial performance is going to change, then those are things that you're also going to want to look at in terms of thinking through what these impacts are. So I think once you get started in terms of assessing the impacts, and I know many of you are going to be starting that soon, I think you'll come to think about the fact that the impacts may be broader than initially thought, and it's worthwhile spending some time to think through all of those stakeholders that may be impacted. And John, I'll turn it back to you.
Thank you very much, Cindy. I think we have our final polling question now. What level of impact do you believe the new revenue standard will have? Will that be a significant change to current practice, an immaterial change to current practice, not assessed, or not applicable? Remember to click on Submit Answer. So while we're waiting for the results, there is another question for you, Cindy, and it relates to implementation. And the question is, well, why get started now? The standard's mandatory effective date is still more than 2 years away. It seems like quite a bit of time.
I think that may be true for some entities, but if you look at the way that some industries are impacted, like the telecom sector, they've actually been working on this for, I don't know, at least a year, if not more. So, I think you've got to start at least thinking about how big of an impact is this on your organization, and how are you going to actually implement the standard. If you do full retrospective, which you may want to do to maintain trends, then you're going to have to sort out what the impact is on your contracts in the near term. I think, too, if you have big system implications related to the standard, those take a lot of time to deal with. So I think, from our experience, certainly some larger companies and the telcos have all started to deal with it prior to the finalization of the standard. But now I think, as we talk to more and more companies about it, they're getting started now. The standard is final, and it's a good time to at least do a preliminary assessment and figure out how much work it's going to do to implement the standard.
Okay, thanks a lot. Let's see if we've got our results. Oh, this is an interesting split. So, 38% haven't yet assessed it. 28% think the change will be immaterial, and almost a quarter say it will be significant. Again, it's going to take some time to figure all of this out, and I guess the devil's going to be in the details. Okay, so please don't hesitate to take advantage of our global publications and resources related to IFRS 15. And look out for Canadian versions of IFRS 15 Industry Insights for a number of industries that will be headed your way soon. Also, please don't hesitate to contact any of our experts, and you'll see their names on the screen. A couple of them should be familiar to you now. They'd be more than happy to assist you with any questions or concerns that you might have. Okay, this ends the formal part of our presentation, but before we begin our question and answer period, just a note to say that we do appreciate your feedback and kindly ask that you fill out our survey. You should expect to see a pop-up survey appear on your screen shortly. It assists us in development of our future webcasts. We take these surveys very seriously, so please continue to send us suggestions, and feel free to also let us know what we're doing well so we can keep it up. We do have quite a few questions in the queue today, so we won't be able to get to all of them, particularly those that relate to specific fact patterns for your organization. I'd recommend that you discuss your questions with your Deloitte partner or Deloitte contact so they can help you resolve any questions or concerns that you might have. So I think getting to the questions, let me just get to the queue here. Quite a big one, as I said. Okay, the first one is for Maryse. And the question is, on a long-term construction contract, would the revenue recognition be based on a milestone schedule, for example, instead of measuring percentage of cost completed?
Okay, sure. Good question. I guess with IFRS 15, I think similar to what we had under IAS 11 on construction contracts, the standard acknowledges that there's different methods of measuring the extent of satisfaction of a performance obligation. And the standard basically says that there's different appropriate methods that might include, output methods and input methods. So in output methods, it's acknowledged that there's different methods again, so it could be a milestone method, it could be a units produced, or some type of measure based on some output. I think the idea is that, although IFRS 15 acknowledges that you can use an input or output method, it encourages or tells you that the method chosen needs to reflect faithfully the entity's performance in satisfying a performance obligation. And it also indicates that you have to challenge yourself on that. So if you do choose an output method, and the example given in the standard based on units produced or units delivered, that may not necessarily reflect the entity's performance in satisfying the performance obligation. If, for example, there's work in progress or there's some finished goods that are controlled by the customer that are not included in that measure of progress. So we have to take a note of that. And also the standard highlights that certain costs need to be expensed, and costs that relate to satisfied performance obligations or partially satisfied performance obligations in a contract also need to be expensed. So those are things that I would put out there as consideration points, John.
Okay, thanks, Maryse. Actually, we have a related question for Joyce. The question is, any fundamental changes to construction contract revenue recognition under the new standard?
Thanks, Joy. There is. I mean, currently under the existing IFRS guidance, when you have a construction contract, you automatically fall under the scope of IAS 11, and it gives you, your revenue recognition guidance in there. Typically is over time, and you take into consideration, recoverability of the work performed, recoverability of the consideration to be received, and that will dictate, how you account for the construction contracts from a revenue perspective. Under the new standard, there is extensive guidance that talks about whether or not you would recognize revenue at a point in time or over time, and particularly with constructing an asset or a construction contract, in situations where, you're not delivering benefits to the customer throughout the construction process, then you fall under the section where you need to consider whether or not, what you have constructed has alternative use, and whether or not the entity is able to enforce payment in an amount that is approximating the purchase price or the selling price of that asset, whether or not it's fully constructed or partially constructed. So in order to be able to recognize revenue over time, you need to meet those two conditions, and which is not something that we currently need to assess in terms of the amount that you can enforce payment for. So I would say, in applying the new standards, company would need to look at all their contracts, how it's being structured, particularly around the payments term, the amount that's being paid, and whether or not at any point during the contract term that, the entity is entitled to an amount that approximates the selling price of the assets in progress in order to be able to support revenue recognition over time. Otherwise, then the standard would tells you that you would need to recognize it at the point in time, and you need to then assess when that happened, and which is you need to assess when control has been transferred to the customer.
Okay, thanks, Joyce. Another question from Maryse here. Maryse, what would you consider at or near the same time, i.e. what period, related to contract combinations?
Yeah, and another very common question I think that we previously had as well in application of prior GAAP. So under IFRS 15, I think there's no clear or explicit threshold or guidance to look to in terms of determining what time proximity you need to consider. I think the closer the time period, the more likely that some contracts will need to be combined. The further away the time period, obviously, at the other end of the spectrum, less likely that the contracts will be combined. But it's not just a question of time proximity. The standard talks about a number of criteria, and they say, if contracts are negotiated at or near the same time with the same customer, and you meet one of the following criteria, then, you should combine those contracts. And those criteria are that the contracts are negotiated as a package, so really to do one single project. The amount of consideration in one is dependent on the price or performance of another contract, and the goods or the services promised in the contracts are a single performance obligation in accordance with assessing the other pieces of the literature that we covered today. So I hope that helps, John.
Great. Yes, it does. Thank you. Okay, we've got a question here for Cindy. What are the significant differences between this new standard and the equivalent U.S. GAAP standard?
Okay, so actually I think the boards did a nice job in actually laying out those differences. So there's an appendix to the basis for conclusion, which lists the 5 different areas where IFRS 15 differs from FASB Topic 606 in terms of the new standard. And they are, first of all, related to collectability thresholds. So as we've talked about on this webcast, there's a requirement to assess probability of collectability. And because probable has a different meaning under IFRS and US GAAP, that's identified as a difference. There's some different disclosures required with respect to interim disclosures, the US having additional disclosure requirements. There's a difference with respect to being able to adopt the standard early. So I think as Maryse mentioned, under IFRS you can, under US GAAP you cannot. There's a difference related to impairment reversal. So I touched on having to assess contract costs for impairment and then having to assess whether or not those impairment charges could be reversed, and you can't reverse them under US GAAP. And then finally, there's different requirements in terms of dealing with non-public entities. So those are the listed differences. The only other thing I would point out is when you're dealing with like this standard and another standard, so Maryse touched on if you have contracts under multiple standards, the other standards could be different, right? So you could run into actually differences in treatment, not because of what's in IFRS 15, but because of how IFRS 15 relates to the other standards, or the equivalent U.S. standard relates to the other standards.
Collateral damage, as they
yes.
say. Okay. We have time for one more question for you, Cindy. The question is, I've read through the disclosure requirements of the standard and noticed the use of the word shall. What does that mean? Does that mean that all disclosures are required?
Well, if you've read through all the disclosures, there's a lot of disclosures there, and I think that you certainly have to take into consideration what's material, and the guidance does talk about some objectives with respect to disclosure requirements. So, I'm not sure we're at the point where we'd say every single line item is required from an IFRS perspective, but certainly you need to go through them to assess how they apply to your organization and whether they provide meaningful information to the readers of your statements.
Okay, thank you. And thanks again to our speakers, Maryse Vendette, Joyce Lam, and Cindy Veinot. Also thanks to our behind-the-scenes team, Nura Taif, Kieran Dulay, and Elise Beckles. We hope that you found this webcast helpful and informative. If you want additional information, please visit our website at www.corpgov.deloitte.com. And to all of you viewing our webcast today, thank you for joining us, and happy Canada Day. This concludes our webcast, Bringing Clarity to an IFRS World, IFRS 15, Revenue from Contracts with Customers.